This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, hello, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and welcome to tonight's Q&A open house session, where we are going to review the markets. We're going to look at some of the technical signals that are out there, and we're also going to analyze your individual stocks. So be ready to type in stock symbols, but don't do that until I prompt you to do so, because we are going to get lost in the shuffle. If you type it in now, it'll wash off the screen because it's a scrolling Q&A box. Okay, so this is a 1-year daily chart of the diamonds, which is the Dow Jones Industrial Average ETF. And the lines that I have on here right now, particularly this line, is my forecast line from last Friday's report. And you might think, wow, well, you're already wrong, AJ. Well, remember, this is Monday, and we still have Tuesday, Wednesday, and through Friday. And what I want to point out mostly is that next week, the U.S. markets will have a shortened trading week because of Monday being Memorial Day celebration. And why is that important? Well, there's an old saying, I don't know how many of you have heard this before, but the saying goes, sell in May and go away. What is that? Well, there's a cycle in the markets where many investors and even traders alike will sell at the end of May, and they'll start to think about lightening up for the summer, taking vacations with their families. And a lot of times you don't see the volatility come back until August, and even in some cases right up until September. And then we get a little bit of a rally towards the end of the summer, and then we get another big sell-off generally in September, October. That's the cycle that I have been exposed to for, well, since 1982. So we're talking, 35 years now of my 36 years now being exposed to that cycle. Now, in between, I would have to say that it's harder for investors to go through what's called the summer doldrums because of the lack of volatility. However, for the traders, and particularly the option traders, this is a great opportunity for us to put on spread trades as option traders, and as equity traders even have the opportunity to trade very narrow trading channels. So while the market volatility tends to slip off, it doesn't eliminate the trading ranges in some of the stocks that stay somewhat active. So what I'm saying here is that the strategy for traders is going to be looking for and identifying trading channels, while the option traders are going to be looking to capture profits from time decay in maybe selling straddles, strangles, selling credit spreads, maybe doing some diagonal spreads. Again, that might seem foreign to many of you, but that translates to opportunity. And we have had a really good week, especially last week for the option trades, which I'll get to, particularly in Baidu. I mean, that was just an incredible opportunity for us to make money, and we did. And it just keeps getting better. So what is the Dow Jones Industrial Average chart telling us right now? Well, today we gapped up. Again, something that you don't see often in the Dow Jones Industrial Average. Why? Because the Dow represents 30 of the stocks that generally drive the economy. And so to have all of those 30 stocks gapping up simultaneously is not a common occurrence. It happens, yes, but when it does happen, it again presents opportunity for us because in almost all of those cases, when there's a gap, the gap will generally fill. And then again, once the gap fills, the markets generally reverse from the gap points. So let me just point one gap out to you right here. Here is an area where the Dow gapped down. The very next day, it went down even further and then started its recovery. It took about 2 weeks for the price to go back up to where the gap was formed. See right there. And then what happened? Once the gap filled, it reversed and then immediately dropped the next day. So there's that pivot point. And so look back at almost every single gap, with the exception of this one that's still open up here in the top left of the chart. Almost all the gaps have filled. So today, the market's gapped up. And right up to a resistance point, it gapped up. Now, I would say, because of a couple of other things I'm seeing on the chart, I would say that tomorrow we're probably going to have a red candle. Why? Well, not just because we're at a resistance point and that there's a gap below the market that'll act as a magnet, but if you look at this candle right here, you'll see there's a long shadow above on the top of that candle. Can anyone tell me what the long shadow above the candle means? Go ahead. I'll wait for that answer because it's something I talk about quite often, and I really want repetition to be the best teacher here. Well, Stewart says it's bearish, and that is correct. Now, why is it bearish? Well, Ken Wolf comes out with an answer that's elaborating a bit. Sellers push price down. That's correct. So before I switch to the intraday chart, you'll see that there is no shadow below the candle, which means the market opened on the low. It traded up all the way to this high, and then during the course of the day, the sellers pushed the price back down. So now that's the story about what that one candle tells us. Let's look at the minute by minute so you can see exactly what happened. It gapped up right here. The stock opened on its low of the candle, traded up till right around, was at 10:45 a.m. And then at 10:45, guess what? Buyers gave up. Sellers moved in, pushed it right back down to the low and even below where the market opened. So right here at 11:33 a.m., there was a candle showing, a red candle, by the way, with an extremely long shadow above the candle, again, at 11:33 a.m. And then what happened? The market stayed in a fairly narrow trading range where the day traders had their way with the price action. And that's what that one candle told us on the daily chart, is exactly what we described in the minute chart that goes and tracks the whole day's activities right there. So going back to the daily chart. Oh, before I do that, I want to show you something. Another saying: the amateurs open the market, the professionals close the market. Let me zoom in a little bit more. Hopefully I can get this for you. Look at the volume bars at the beginning of the day. See how high the volume is built up? And then when you go throughout the rest of the day, the volume wanes off here to where it's virtually nothing going on here in volume around 1 o'clock in the afternoon, 1:30. And it stayed in that range. But look at towards the end of the day. Look how the volume started to increase towards the end of the day. This is what I pay most attention to, is the volume at the end of the day, because that's the money managers, the fund managers, the hedge fund managers, the professional traders. They're all jockeying their positions at the end of the day, which is why I put so much more weight into the closing action of a trading day. And for those of you who have been following along with our subscriptions, it's one of the reasons why a lot of times I tell people, not all, but a lot of the time I tell people wait till the last half hour of the day and let that shake itself out, and let's see what the professionals are doing coming into the close. Now, this gray area right here, see this? This is after hour trading. That's after 4 p.m. And the last tick right there is right very close to 6:30. And so most stocks nowadays will have after hour trading activity that's being logged in on the daily chart, on the intraday chart rather. And so you can get a feel for that. You can see that there was some selling activity after the close that pushed the price, the Dow especially, down a bit, which it dropped, let me see, about 12 points after the market closed today. And so going back to my daily chart, I think there is a very good chance that tomorrow we'll see a red candle. And possibly and I'm going out on a limb here, but it's very possible we open up right at the unchanged level and trade down to fill the gap. That could very well happen in one day. On our Market Guy Facebook page, I posted an article that came from CNBC that was quoting Goldman Sachs. Let me get to that right here. And some interesting things came out. Goldman Sachs says the fiscal outlook for the U.S. is not good. And reason they say that, I'm not going to go through the whole article here. I'm going to bring it to a chart, is because the public debt right now in billions they're talking about how it could equal the gross domestic product within a decade. Now, if that happens and our debt is more than what we're bringing in as a country as far as productivity, then it's going to be almost impossible for us to recover, because at that point, the interest rates to finance the public debt is going to far outweigh what we're taking in gross domestic product. And that's why the president, whether you agree with him or not, that's why he's trying so hard to put tariffs on to get the U.S. economy stimulated enough so that we're exporting more than we're taking in, which in turn increases the GDP, which in turn, if Congress and the rest of the lawmakers really get a hold of this and start to at least make an attempt to show investors and our public citizens that they're making an effort to get our debt down, that will bring back optimism. But right now, from what Goldman is seeing, there is no attempt. And you can see that the charts are going in a 45-degree angle here with the public debt accelerating. And you see the divergence between the GDP and the public debt is narrowing right here. And that is cause for concern, because what will happen is interest rates will start to go up. That, in turn, will push prices down in the general markets. Could very well be good for gold and silver. We'll have to see about that. But it's one of the reasons why I continue to build a precious metals portfolio, because I am preparing for that one day that the bear market starts to show its head, and I'm not going to be caught by surprise. So I know I took a lot of time just explaining this one market right here, but let me go on to a more broad-based index, which is the Russell 2000. And let me explain to you what we're seeing here. This is an extremely long stretch of almost vertical price action. And I will hop from this to an individual stock before we get to the rest of the markets, because I'm going to show you how powerful this rubber band effect is. Right now, Russell 2000 is showing a very wide divergence. It's one of the widest divergences we've had in a year, the upside divergence, that is. And it's long overdue for a snapback. Now, last week I identified this doji. Today we have another strong green candle. The Russell 2000 chart here does not register volume, so it's hard to make the volume read. So we read that from other markets, and you'll see that's easy to do when you're combining the other markets in your analysis. Anyway, wide divergence from the moving average. I'm expecting it to pull back. This is a 2-week forecast, by the way, because remember, next week we have 4 trading days. So 4 trading days with our 5 trading days this week will give us 9 trading days, which will really project us out into this area right here. But I still have my target down at the end of that line, because I think that the Russell 2000 especially will pull back to that 20-period moving average. and do something very similar to what we saw back here in March, where we had a small candle, and then we had a wide divergence, and then it snapped to the 20-period moving average, and then went beyond that moving average to the downside. Rubber band got stretched, and it snapped right back. So we got this oscillation going on to the tune of, it's almost like you're reading an EKG here. You see how regular these tops are? See how they're spaced out so nicely? You have one here, you have one here, you have one here, you have one here, you have one here. I'm not going to put timelines on here to measure the cycles, but you could put cycle lines on here, and you'll see that we're very, very close to the top of another cycle. Now, with that said, I do not really feel that great about taking any new or aggressively long positions. Why? Well, here's, I'm bringing up Baidu. Our option traders are probably breathing a very loud sigh of relief, because we had a wide divergence from this blue line to where the price is. Does it look familiar? Very, almost identical to what we saw just a little while ago with the Russell 2000. Our option traders were long puts, and some were short call spreads, which are bearish. And Wednesday, and actually on Tuesday, Wednesday, and Thursday last week, it was creating pain for those people who were short Baidu. I made a recommendation to our alerts to hold on. And on Thursday right here, which is the 17th, it looked as though we were going to lose money. Well, lo and behold, what happened? Friday, right there, the 18th, the company makes an announcement that their COO is resigning. The stock collapses literally in a matter of hours of that news releasing, snapped right back to the 20-period moving average. Today, it went even further on pretty strong volume, but still lesser volume than what it was on Friday. Filled this gap right here, right? 80% chance gap will fill. It did. Now there's an 80% chance that the stock will reverse and possibly bounce, bringing us right back to that 20-period moving average. So again, for our subscribers who got the alert today, I am expecting a little bit of a bounce. So we enhanced the position. We took a long position today by selling the 240 puts, which when put together with our other position balanced it out a bit. And anyone who's been trading Baidu with us is making a lot of money right now. This is the home run trade of the year that we continue to milk profits from. And I only expect this one to get a little bit better. So if you have any questions about this towards the end after I get finished, feel free to type in your questions and ask away, because I'll be very happy to elaborate a little bit more on this particular stock. Now, I got to watch the time because we're already 17 minutes into this, and it just flies by like lightning here. If I look at the spiders, which is the S&P 500 ETF, same scenario as what we saw in the diamonds, with one exception, is that it didn't gap up today. The S&P 500 stocks being monitored stopped right at, it closed, in fact, right on that resistance line. And if you look a little bit more closely, you'll see that today's volume is less than what it was on Friday. So even though that's a green candle, that's telling us that the buyers are not as forceful as they were, and that this could, again, lead to lower prices in the S&P. So if the diamonds have a gap below the market, the S&P looking bearish, Russell 2000 looks overextended. Again, all evidence is telling me that there's a likelihood of the markets dropping back down. Now, finally, the Qs, and then I'll look at the VIX, of course. The Qs were a little bit more tame, and we had a red candle on the Qs. This is the NASDAQ market and the power shares. I think out of all the markets, the Qs are most likely going to follow my forecast line to the letter. And again, we still have 4 days left in this trading week with a shortened trading week next week. So I think we can very easily pull back in the Qs. We see that drop in volume as well. Now, the VIX, which is my ultimate leading indicator outside of volume, That's the VIX is still right on target for what I forecast. I said the VIX will start to come up. And if you look underneath the shadow of the VIX, there's a longer, underneath the body rather, there's a longer shadow than there is on top. The only thing is that today the VIX is showing a very small bearish engulfing pattern. So whether or not it's going to go right up from here, I don't know. There's an 80% chance it could drop a little bit before going higher. Again, because of that bearish engulfing pattern, but we keep an eye on that one as well. Okay, now, who would like to submit their first stock symbol? And again, for those of you who join us for the first time, welcome. Welcome, welcome. I don't see a name there, but I see Boy of Metal. That's the first time I've ever had someone identify themselves as such. Welcome, Boy of Metal. And I'm looking forward to getting some stock symbols from you as well. Okay, Ron is looking at CNP. Now, if you're typing a stock symbol, please remember it's always best if you put in what your intentions are or put in what you think you're doing with the stock if you have a position in it already, okay? So Ron is looking for a good entry point. Now, Ron, remember what I said about the general markets. It's one of the reasons why I start off analyzing them first. Because if we see that the general market, in the overall markets, I should say, is looking more bearish than bullish, then we probably don't want to get too aggressive with any long positions. Now, with that said, I will point out here, let me back up a little bit because it looks like we analyzed this once before. I'm going to go to the weekly chart. Yeah, this is in a major trading channel, and it was back here. When was that? That was last year in May. Drew this line right here saying that it's probably going to pull back in that channel. Well, it's actually starting to do that now, and right in line with what we drew in that forecast back then in May of last year. But you can see that the stock is in a downward leg within that trading channel. I'll erase these now because those are a year old. But let's take a look at something on the weekly chart before I go back to the daily chart. My eye gravitates to this high. Right there. Can anyone tell me why I'm looking at that high and not this high? Would anyone like to even take a stab at that and even an educated guess as to why I'm looking at that high? Would anyone like to see it's a little bit of a delay in the answers? No answers yet. I'll keep watching for that. Well, here's why. If I take a line and draw it horizontal from that point, you're going to see that the horizontal line right here, which used to be resistance, see this high was established as resistance. Resistance was tested just a short time after that, 2 months after resistance was tested. And then, and this is in September, and then what happened is in December of 2016, it broke through that resistance, and the resistance became support. And Ken Sterling got it perfectly when he typed in roll reversal. D, you're correct as well. I drew that as resistance. But once the resistance is broken, it turns to support. And interestingly enough, the week of April 23rd, that low matches to the penny of that high back here. All right, now that we see that that's a roll reversal support, that gives us a little bit more comfort, I guess you could say, for Ron's long position, should he decide to take a long position. Now, that horizontal line that we drew down there for you, Ron, that would be our risk management point. So if that line is right around 24.77, then you could only give yourself maybe $1 risk per share, or maybe you can go 50 cents risk per share. In other words, if you decide to buy this one, you're going to put your stop somewhere below that support level, because if it breaks down below that support and the volume starts to increase, this stock, again, according to that weekly chart, this stock could go right down to $20. and now you're going to lose 20% of your whole position because you held on too long. So it doesn't sound like much, but 20% is 20% of the stock price. So that's a good thing for anyone thinking about buying. A second thing that I would measure as a positive is that the gap here has filled. Well, what's the rule for gap trading? 80% of the time, after a gap fills, it generally reverses. Here's a prior gap. It gapped down. The gap filled here. What happened after the gap filled? It dropped. It reversed. So now that this gap is filled, what's the chances of it reversing? Pretty high. So I would put this as a forecast. I'm going to try to do this in an angle that matches previous upward legs. So this angle here is more or less matching this angle here, and even maybe this angle here. You see the angles that I'm drawing. So I think there is a chance that this could rally. I don't think it's going to get away and go up all the way up to 30, but I think on the safe side, this stock could rally, 50 to 70 cents. So as a short-term play, I think that's a candidate. The other positive thing is that if I zoom in, you'll see there's 1, 2, 3, 4, 5, 6 red candles in a row. We're at a point where we call this what? A stale red light. Last time we had 6 in a row, it was back here. 1, 2, 3, 4, 5, 6 candles in a row right there. So I'll count them again. 1, 2, 3, 4, 5, 6. Then what happened? It bounced. So we are at that point where the stale red light is telling us expect a green light. If I were trading, the only thing I would look for is a slight drop in that volume before I jump in. Even if it's a red candle tomorrow, I would still get in if the volume was lower than today, because if there's 7 red candles in a row, it increases the likelihood of a green candle showing up in the near future by X percentage. So you're on a support level. So if you buy it, you still have a little bit of room to play in here. All right. So just for fun, for those that don't even want to trade this one, at least track it. I would encourage you to track it. For the members, this broadcast is being recorded, so you can go back and check the accuracy of what we're doing here. Okay. D is asking me to look at BCOR, and D is long BCOR. This stock is one that if I were long, I would immediately be selling it. Hint, hint. Why? Well, actually, this is just the opposite of what we just saw in CNP, right? There's a gap below the market. There's a wide divergence above the moving average. There is what very, very close to a stale green light. With the exception of these 2 red candles here, there really has been no respectable pullback whatsoever. So, D, where are you long this? I'm just curious. What's the price? Do you have an entry price where you got long that one? So I would be selling it mainly because today is a perfect doji right there. You don't see those too often unless they're at a pivot point. It's a perfect doji where the price opening was matching with the closing price, and that is usually a sign of indecision, and we see that on lower volume. So my forecast on this one is that it's most likely going to pull back, and I'm going to give it a 50% pullback from this leg. Yeah, sure, it could come back to fill like app one day, but I think reasonably we could expect a 50% pullback of what it gained from 25 to 37 up here, right? So a 6-point pullback is something that I would certainly expect. If you feel like it's going to go higher, well, then sell half the position and put a trailing stop on the rest. That could be a good thing for you as well. And if you don't want to sell all of it, then just keep trailing your stop. Here's what I mean by that. And this is a great lesson for those who are just new to the idea of trailing a stop. From this day forward, so in other words, from May 15th to the present day, you could see that each one of these candles has had a higher low and a higher high. Okay, candle right here, high in the low. Next day, higher low, higher high. 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 All right. So what I'm expecting is the stock to not set a higher high tomorrow. It might set a higher low, but I don't expect this one to set a higher high tomorrow. That would be called a half signal. A full pivot point is when, let's say tomorrow, you have a lower high and a lower low. But if you have a higher low and a lower high, that's a half signal. I know if I say that too quickly, I'm going to confuse you. But right now, everything is looking bearish. So what you want to do in trailing your stop is you want to put your stop beneath the most recent low prior to today's low. Okay? So if you're going to look at this as a possible pivot point, but you want to trail your stop up, you would put your stop below Friday's low right there and give it a little bit more room to breathe, because we could have a higher high and a lower low, you see? And that's a half signal as well, but it's giving you enough room for that stock to breathe while still being able to capture whatever profit you have built into that. So you bought this one at 32. You're up $5 and change. That's a respectable profit. I certainly wouldn't allow that positive trade to turn into a negative loss. I would hate to see that, and I hope you really protect that. All right. Good stocks, good questions. Hopefully those who are just being flies on the wall will take some good notes here and follow along with us. Bob puts a question out asking for BLNK, and Bob wants to buy the stock when the gap below the market fills. Now, let's take a look at that, because, Bob, there's a couple of things I want to point out to you as the past history of the stock. You see this? It's got peaks and valleys that will cause you to lose sleep. This is I wouldn't say this is a stable stock, number one. But number two, one of the reasons it's not stable is because if you look at the volume, okay, it looks like the volume is even erratic. I mean, prior to May, I'm even looking for the volume. I don't even see it. What's the volume here? Daily volume in May, in April, you're talking 17,000 to 29,000 up to 150, 175,000. So the volume is very erratic. What does that mean for someone who wants to trade it? Well, if it's not liquid enough for you to put a stop loss in, then this is a stock that could gap down with these huge gaps that it has. So in other words, if you buy, let's say you bought it at 7, or you decide you want to buy it at $6 here when the gap fills, yeah, you could do that and hope that it'll reverse. But if you put a stop at, let's say, 5.5 and below that gap fill support level, because of the illiquidity of the stock, it could wind up opening well below your stop price, and now what you bought at 6 is now trading at 3, and you're just getting out with a 50% loss, you see? So that's a very dangerous stock to trade. And secondly, if this stock drops below $5, you may have heard me say this before in other calls, if it drops below $5, the margin requirement changes. So what happens is the brokers who hold the account will allow you to borrow margin money, and if it's not you, it'll be somebody else. But they'll allow people to borrow money in their margin account to buy this particular stock. But when it drops below $5, the broker now sees that as an extreme risk. So what they do is they tell their shareholders either sell out of the position because you have a margin call now, or you could bring in more money to hold the position. And guess what happens? Most people sell out of the position. because they don't want to bring in more money to finance a bad losing one. And so what happens is when a stock drops below $5, it will usually go a lot lower. And you can see that it did just that. When it was trading $9 one day, next day it's dropped to $3 and then continued to go all the way down to almost $1. So you can see how this whole area was a major margin call area where there was so much pressure put on the stock that they just got out. So I don't want to burst your bubble here. I think there is an opportunity if it fills that gap that it could bounce, but I certainly wouldn't be trading it in big numbers. I would do my best to go ahead and put a stop on it if you could. And if at all possible, try to find another stock trading for $7 that has a little bit more liquidity. And that would be my best coaching tips for you right there. Okay. David puts out FITB. Is this Fitbit? Let me see. FITB. Oh, Fifth Third Bank, of course. All right. That's Fitbit. FITB, Fifth Third Bank Corp. This one is something that David is looking at. He says selling puts at the $29 strike to take a long position. Now, I like that idea, actually, David. I like that idea because what I can see here is a well-defined trading channel at this point. You see this? And this is kind of what I was alluding to at the beginning of the call when I said there's opportunity for option traders during the summer doldrums. I don't know what the news is on this one, but chances are they were either downgraded. Let's see. Wall Street climbs, trade wars, see Fifth Third Bank, largest decline. Okay, so this is all fundamentally related right here. Analyst notes are coming out on this one. Analyst notebook on FITB. Okay, so there was negative news that came out. No big deal about that. And that doesn't usually cause me to shy away from a stock because I know that even under the worst news conditions, Chipotle Mexican Grill, customers suffer food poisoning, right? I mean, how much worse can you get than that? But CMG came back and recovered. And what happens usually, especially when you see a banking stock, when investors hear news, they generally overreact to the news. Now, if you sold a $29 put, what that's doing is if you sell a put, it's obligating you to buy the stock at 29. All right, now let me just look at this. And for those of you that don't trade options, just bear with me because this is really a great lesson. Even if you don't trade options, it's going to help you at least understand just a little bit as to why options are have an impact on the market. Now, from what I can see here, okay, David, there's not a lot of premium in those puts. I mean, for the life of me, I don't think I could get myself to take that kind of risk for just 50 cents. That's number one. Number two, there's got to be a reason why those puts are so cheap. Now, I'm not trying to talk you out of position, but what I am doing is trying to expand your horizons to look at a different type of a long position, which I think could help you. All right. So if you're only collecting 50 cents to obligate you to buy the stock $2.50 lower, well, what if the stock goes to 28? Now you collected 50 cents, but now you're losing, $1 minus what you collected. So if the puts are too cheap because the general market is bullish, then that means the calls are also going to be cheap. And so what you could do is look further out in time and maybe look at as far as January 2020 and look at the leaps, okay? And instead of selling a put, you might look to buy maybe the $30 calls or maybe even the $27 calls. I don't like the spread between there, but the $30 calls have a pretty tight spread. If you could buy those for $4.25 and hang on, and then the stock rallies up to fill this gap, you got a home run right there. All right. If you spend $4.50 on that leap, and the stock goes up $3, the price of that leap is going to go up about $3. So you're getting a huge percentage of return just by having the gap recover. Okay, so that's some idea for you instead of selling the put. I really think you're going to make money if you sell the put. Don't get me wrong. But I don't think it's worth the risk for the amount you're collecting. You see, because there's more downside risk than there is upside potential. However, with the long leap, there is a very strong probability of a strong ROI because there is unlimited upside to the call. See, when you sell a put, or any option for that matter, the most you can make is what you collect when selling the option. But when you buy a cheap option like that, there is unlimited upside potential. So if that stock goes to 35 and beyond, 40, 50, whatever, you're magnifying those profits exponentially at that particular point. Okay, hopefully that helped you out. All right, looking for more stock symbols. All right, keep typing in. All right, we have a little bit room in the Q&A box, so keep typing in. I'm up to Bruce level right now. LB is what Bruce is looking at, thinking of buying calls to open, going into earnings on high volume today. That's very interesting play because LB, and like any earnings play, it is usually a high risk because it's really, unless you have access to the analyst who's releasing the numbers, I really don't know how that is a guarantee of anything. I think you might even have better odds. You'll have better odds at the Belmont Cup when they come to finish the Triple Crown race out there. But what happens here, and here's some good things for you, is that today the stock has showed a very, very slight green candle on higher volume. That's good. But, and here's the big but with a capital B, it didn't close over the 20-period moving average. See that? So if the stock had closed over the 20-period moving average, I'd say go for it and close your eyes and just keep your fingers crossed. But the thing is, the 20-period moving average is acting almost like a resistance point, and the stock is showing a long shadow over that candle like we saw in those other stocks that were more bearish. So with that said, if you're thinking about buying calls to open and it's an earnings play, you would not go as far out as like a leap or a January option. You would stay close in because it's a very short-term strategy, but you would still go with an in-the-money option to give yourself a little bit of leverage on the intrinsic value. I know for the non-option traders, you don't know what I just said, but Bruce knows what I'm talking about. If you go with an in-the-money option, you're actually safer than having the volatility get sucked right out of that, and you're going to lose money on just like the first minutes after the earnings are released. So if you do that, I would do it small. I would still protect myself with the get-out point ahead of time before you get in. The gap filled on Friday, which could tell us it could reverse and go the other way. It's very possible. But it's not. It doesn't look like it's a potential home run for you on this one because look at the past. Look at this. Big gaps. It's been a downward market since the beginning of the year, and it's got this huge cycle. I don't see again any really big explosive moves happening in the past year to the upside that will help you. So just again, word of caution: be very, very careful. All right, Tom is looking for an entry point in Snap. Now, this is one we took a position in. The equity traders took a position in Snapchat, and we bought it back here right around 11. I think it was 11:03, if I'm not mistaken. I don't have my sheets in front of me. I think we bought in 11:03. This one is just kind of hanging out. Now, interestingly enough, my son is home from college. Okay, so let me just tell you a little personal story. I'm not going to get too deep in this one, but my son's home from college. His girlfriend, who goes to school with him, is home with her family up in Vermont. Well, every time I pass by his room, I see this bright flash from his phone, like he's taking a picture. Let me tell you, the younger generation, I'm not into the Snapchat scene, but let me tell you, there is a certain level I would even call it a certain level of addiction where people just have a need to stay connected. Now, with this this big thing with Facebook and all the scandal with privacy, some of you may have seen the commercials that Facebook is putting out for protecting your privacy and looking at the warm, wonderful, fuzzy commercial about how we all need to stick together and we have each other, you know, and the violins play and all that. But what happens is people really like to stay connected. And Snapchat has a privacy feature in it where the younger generation will do the Snapchat thing and then the message just disappears into space. And so they like that sense of privacy, but it still allows them to stay connected with different filters they put on and I think what's happening, and I think you'll see it in the next earnings report for Snapchat, I think they're starting to figure out how to monetize the audience with regard to advertising dollars coming into the company. I think they're going to figure that one out. Instagram hasn't figured that one out yet, with the exception, if you looked at an Instagram, I'm doing my very best to learn about the social media platforms. Instagram will throw commercials into the data feed. So people will be communicating with each other, but then all of a sudden there's a video that catches your eye about this wonderful invention that shows you how to find gold in your bedroom at night or whatever it is. You know, and it's like they just have this really eye-catching advertising strategy that really gets your attention. So Instagram, which by the way is owned by Facebook, they figured that one out, but Snapchat hasn't gotten it yet, but I think they will. I know that's a long explanation as to why we're still holding on to that position, but technically, which is the most important thing, I think anywhere in this area right now, Tom, I think anywhere here between 10.5 and 11, I think is a good entry point to at least hold the position until it gets up to around the 1380 level, which, by the way, is when we will be getting out. We have my line set up here. I have an alert set. So when that gap fills, we are getting out. And I would encourage you to do the same, because once the gap fills, high likelihood that the stock is going to reverse and go the other way from that point. Okay. Spent a lot of time on that one stock, but let's go. We'll keep moving. Ken is asking about silver. Why does silver gap so frequently? Oh, great question, because I absolutely love trading the gaps on silver. It gaps quite frequently because SLV is tied to the commodity exchange in New York. And as a former futures trader who specialized in these gold, silver, platinum, copper futures, I'll tell you that the volatility is connected to the world economy and the global currency markets, because silver is not just a commodity that's used for an industrial metal and jewelry. It is also considered to be a currency. So it's got a two-faced meaning to SLV. And so you might look at the news coming out of COMEX that silver is down or up based on what the Fed is going to say about interest rates. And you can even see the article I showed you at the beginning of the program here, Goldman Sachs believes that interest rates are going to start to increase. Well, all you have to do is have some economist make a projection on interest rates, and guess what? Silver is going to gap. So I'm not afraid of the gaps. In fact, on the contrary, I use them as a tool. Last week, I took another long position. I added to my position when this gap filled. See this right here? That gap filled. And on that day, I didn't even wait till the close on that one. On that day, I bought SLV. I think I bought it at 1553. And I now see that this gap is filled. Now, what you might say, well, AJ, if you bought it at 1553, it's trading 1554. No, 1553. No, I bought it at 1533. Excuse me. You say, well, why are you not getting out with a 20-cent profit already? Well, I'm not day trading it, number one. Number two, I'm accumulating it. And number three, if you look at silver today, it closed above the 20-period moving average with a long shadow under the candle. That's good. And it's higher volume today, which makes it even better. You see this alert up here at 1611? That's where I'm going to sell out of my position right there. So I'm going to try to take $1 out of that when the time comes. I won't sell out of all the position, but I'll sell what I bought back here only to get back in when it drops back down to more or less parlay the position and get more shares out of it. Okay, follow-up question to Ken's first question is gaps in gold and silver don't seem to fill. Oh, okay, well, they actually do. If you look, especially GLD. GLD carries a little bit more weight with regard to the gap fills. But you can see that the gaps filled. Gold GLD gapped all the way up here. Gap, 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 gap. It filled 50% of these gaps. There's still a couple of gaps down below. But if you go back in time, look what happened. Gap here, right there, filled, reverse, went the other way. Minor gap up here, filled here, reverse, went the other way. Gap one day, filled the next day, bounced the next day, gap down. Again, those are trading opportunities if you have the patience and the strategy to protect the position along the way. And if you don't want to trade GLD because maybe it's too expensive for you, then trade IAU, which is basically trading 1/10 that of GLD. All right, so if GLD is trading 124, then this is going to be trading 1241. See, so it's 1/10. And so you could trade that and get more shares and still get the same benefit of the gap fill strategies. You can see same gap up area, just like GLD, same thing, just a lesser version. All right, David. All right, thank you. And thank you, Ken. All right, Ken also has WDC, question on that. Watching the time, we have about 9 minutes left. Tell you, if I had some sponsors and a radio frequency, I'd be broadcasting this all over in the public airways, but we have a closed audience right now, and I really appreciate all of your input and your stock symbols. It really makes for a much more exciting event for us right here. Okay, so Ken has the January 2019 calls. You're owning those at the 29.5. All right. Well, this is a tough one, Ken, because I would probably get out of that one, whether you're up on the trade or not. And here's why. Again, it goes right back to the rubber band effect and the gaps. This has a gap above the market, but I don't see the volume here now. I don't see the volume supporting this most recent upward leg. So what I think this one could do is I think it could come right back down to fill that gap. Remember, I'm always keeping the general markets in mind and how we analyze this from the very beginning. If the general markets look like they could start to drop coming into the end of May, then this one will most likely drop. This is Western Digital. It's a tech company. And so these spinning tops tell me there's a sign of indecision. The drop in volume telling us that the buyers are getting a little tired. The gap below the market is going to act as a magnet. And the rubber band above the moving average is being stretched. So what I would do is get out of that position, wait for it to drop, okay? And then you might consider selling out of the money puts to collect cash that might offset the original cost basis of the leaps. So you can get out and still keep a bullish eye on this one, so and put an alert. So all you have to do on this particular platform is I think you click here. Yeah, I have the alert. I usually right click. Let me see, right click and set the alert. So right click, boom, and go to alert. Where is it? I know it's in here. Alert, alert, alert. Boom, boom. Create alert. You see this? And then I'm going to put $80 in here. So I'm just going to show you how to actually just put in an alert. Okay, so I'm just going to put 80. And when the mark is at or I want below, okay, when it's at or below, I'm going to put sell at the money puts. All right, with Ken. That's what I'm going to put in there. That's going to pop up. So what happens is with this particular platform, I have it set up so that when that alert fires, it's going to automatically send me an email with the instruction to sell puts with Ken. You see? So whatever platform you're using, I have to believe that 99.9% of the platforms out there have the ability to set an alert. If you don't have it or can't find it on your trading platform, go to your smartphone or go on the line and look at Yahoo Finance. And Yahoo Finance will have alerts for free where you can type in your email and Yahoo Finance will send you the email. All right. But that's a very valuable thing. Just like I have in the silver alert to tell me when to get out. This was one set to tell me when to get in. All right. So I'm going to look at that. All right. Let me see. We have a couple more. Stuart is looking for an entry point in GLD. We just looked at that. We'll look at it again. I don't see any reason why GLD or IAU is not a good entry point right now. Reason being, the stock has been going down. Now, follow me here because this is really important. The price has been going down, but the volume is going down. Now, everyone should be able to answer this one by now. Here's my question. Get ready. I think you know where I'm going with this. If the price of a stock has been moving lower and the volume is now dropping, is that bullish or bearish? And if and why? Okay, let's do that. Let's start with, is it bullish or bearish? Okay, Ken says bullish. Bob says bullish. You're all correct. Absolutely right. Because the sellers are losing their momentum. The sellers are easing up on the selling pressure. I got these green candles here. I like that. It's on a fairly good support level. If you look back here, this is a roll reversal support back here. I could even go so far and say, okay, let's go and put this one as support. Okay, that's support. 118 is support. Not really close, but is support. You got gaps being filled. You got a gap above the market, and you got a wide divergence below the moving average. I think it's the rubber band being stretched to the downside that I find most attractive, because if you look at the past, you'll see that that rubber band has been stretched quite a number of times beneath the moving average, and on almost every single occasion, it snapped back to the moving average. So if you get into GLD tomorrow and you pay 122.5, I would look to get out at 124 or 124.5. Boom, take your $2 profits and run. Boom, done. Okay. Eric says, is there a diagonal spread opportunity with WDC? Yeah, going back to that, Eric, I would say so. Yes, because, but not until it fills that gap. I see this WDC still has that gap above the market, so I wouldn't say try to do a diagonal put spread with that one, not until the gap up here fills. But I think a diagonal call spread is very good opportunity once the gap down there fills. All right, let's see if I have one more. Do we have one more stock in there? I thought I saw one. Bullish call. That was Ken. Okay, that was Ken talking about the bullish spread. All right, SYMC, and I'm going to leave it with this. Ken, let me type that in, SYMC. That is Symantec Corp. And bullish call spread on SYMC at 20. All right, now I'm not sure what kind of a spread, if it's a debit call spread, bullish debit call spread, or a credit put spread, I don't know. But today was very interesting because it looks as though the stock wants to go back down to fill that before it goes higher. So I would be really, really careful with that one, because this is acting almost like an island gap, this whole thing. And you don't see this pattern too often, where you have like a hammer pattern here hanging out all by itself, then it gapped up. I think this is what you could actually see on this stock, and I wouldn't be surprised to see it. Maybe not right away, but I think it'll first come back down to fill this gap, at which time I would be extremely bullish as long as this support level holds. But I think it's going to take a while for this gap to fill, and here's why. Most of the time, it takes a much longer time for the large gaps to fill than the small gaps. So another way to put that is small gaps fill much more quickly than the large gaps. So if you see a gap forming in a stock, be more attracted to using the gap trading strategy with a small gap versus a large gap. So that's what I think could happen on Symantec, and I'm looking at the clock. We are almost exactly at the top of the hour. Folks, thank you so much for joining us. I and the rest of our team, my partner Bill Shanley, are really doing our very best to get the word out, because our market reports are just so accurate. For the life of me, I don't understand why everyone and their brother is not following the numbers. It is in your best interest as well to share that report, and we give you permission to share it with people that are in your household or people you care about most, especially the traders, because the more people who follow the signals, get this, the more people who follow the signals, the more accurate the signals become. If you want to call that self-fulfilling prophecy, I don't care. It makes the fundamentalists go crazy. But if all of a sudden we see a bullish engulfing pattern and everyone starts buying that knows about bullish engulfing patterns, guess what? The stock is going to go up and we will all make money. All right, that's the way it works. It's momentum. We're all momentum players. We're short-term players. We're option traders. We're looking to make money, and we could have a lot of fun in the process. So again, thanks for joining us. I look forward to our next report on Friday going out before the long weekend. Watch for that. And by the way, one last thing. If you're an Oracle subscriber and you're not on WhatsApp, then you're missing out on my free text messaging alerts. Today, when I put out the alert on Baidu, it was a time-sensitive trade. So anyone who is on the WhatsApp notification system was alerted to the fact that I sent out the alert and it's in their mailbox. Some people who may not be on the alert system may have turned on their email box now and saw the alert sitting in there, which will have to be done tomorrow. So again, subscribe to it. It's free. Just download WhatsApp, WHATSAPP. They spell it weird. It's WhatsApp. And all you have to do is text me your phone number and you're in. You're on the list. And you can remove yourself at any time. All right. I went 1 minute over. Apologize for that, but it was important info. Have a great rest of the week. And we'll talk to you soon, folks. Bye-bye.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.